Ready to grow your fortune? Investing is your ticket. Starting with $1,000 may seem small, but it's your stepping stone to financial security. Being a newbie investor has never been easier or cheaper. You have a plethora of alternatives at your disposal to get started. Some ways to invest $1,000 can quickly beef up your cash. Just imagine for a moment snagging a 50% return right off the bat with special incentives. Then you can dive into high return assets. Here's how to invest $1,000 and watch your wealth blossom. 1. Buy an S&P 500 index fund. The best option is to purchase an index fund based on the Standard & Poor's 500 index, which is made up of about 500 of the most prosperous American companies. You can double your money in just over 7 years thanks to the index's historical average return of roughly 10%. Because you will own some of the best companies in the world, and it offers immediate diversification, which lowers risk. It's an excellent choice for novice investors. Warren Buffett, the renowned investor, actually says that purchasing and holding an S&P 500 fund would be the best course of action for most investors. 2. Paying down debt. Paying off credit card debt should be your first goal, particularly in an environment when interest rates are high. Suppose you have a credit card with a $1,000 debt and a 20% annual percentage rate. You only pay the $25 minimum each month. It will take you 67 months to pay down the remaining amount, and interest will cost you $661. Alternatively, you might settle the entire amount and avoid any interest payments. If your debt is significantly higher, you might think that $1,000 won't go very far towards paying off your credit card debt. To avoid paying interest in that situation, you could also wish to choose a debt consolidation loan or credit card with a 0% intro APR. 3. Buy partial shares in 5 stocks. Purchasing a group of 5 thoroughly invested stocks might add some spice to your portfolio and allow you to have a longer investing horizon. But you're better off choosing an S&P 500 index fund if you have a clear understanding of the investment opportunities. Of course, that's a trade-off for investing in individual stocks. Your portfolio of 5 equities will probably be far more volatile than an index fund. Securing a fractional share from one of the top brokers can alleviate any concerns you may have regarding funds sufficient to purchase entire shares of each stock. And since you might be able to obtain a better deal, you should look at the top brokerage incentives for new money. 4. Put it in an IRA. Are you unsure about where to put $1,000? If you want a large potential return, think about a retirement account. If your income qualifies, you can deduct income taxes on the $1,000 with a regular IRA. Defer paying gains taxes for a number of years. Combine this with a bonus for creating an account. Consider the Savers Credit, which provides a 50% tax credit up to the amount of $43,500 if you earn less than $21,750 individually or $43,500 jointly in 2023. Higher earnings can also be eligible for 10 to 20% credits. It's one of the easiest and finest returns you can find. A huge gain with minimal risk. 5. Invest in an ETF or index fund. Moving towards the 5th option, you may invest in the market with a small chunk of money by using index funds and exchange-traded funds. These funds are transparent investments provided by financial institutions. Information about the holdings, fees, and cost ratios of ETFs and index funds is easily accessible. So choose the top broker from the list of the best brokers for ETFs to purchase your ETFs. ETFs provide investors with more options for customizing a portfolio than index funds, which are a passive, broad market investment through the major indexes. $1,000 can be used to select many ETFs with varying risk profiles. One may allocate $250 to a growth-oriented, higher-risk ETF, $250 to a dividend ETF, and $500 to a bond ETF. 6. Build up a passive business. You may start a passive business with as little as $1,000, especially if you're prepared to put in the work up front. Choose an area that you are passionate about, then establish yourself as the authority in that field by building a website or a course. Investing your sweat equity might result in low capital requirements for many passive enterprises. 7. Trade options and Forex. High-risk investments like Forex and options trading are usually preferred by seasoned investors. Derivative contracts, such as options, provide purchasers the option to purchase or sell securities at a fixed price at a later date. Trading Forex involves converting national currencies on an international exchange market. When they eventually become proficient in these trades and achieve steady profitability, traders frequently lose more than $1,000. So before making a sizable financial commitment, it is highly suggested that traders must approach these markets carefully and fully grasp the dangers and complexities involved. 8. Open a certificate of deposit. Imagine for now, you've got your financial basics covered: emergency fund, retirement plan, and no high-interest debt. But maybe you're not keen on taking risks with your money. Well, that's where certificates of deposits, or CDs, come into play. CDs are similar to special savings accounts in that you receive a fixed interest rate in exchange for locking in your money for a predetermined amount of time, usually a few months to a few years. The interest rate often rises with the length of your commitment. The downside is that you cannot just take out your money from a regular CD anytime you want to. You might be penalized if you do. The benefit of certificates of deposit is that they often provide higher interest rates than standard savings accounts. Therefore, if you have your emergency fund organized and in a convenient location, investing a little additional money in a certificate of deposit CD might be a wise choice. It's a method that can help you earn more interest on your investments while maintaining financial security. 9. Buy Treasury Bills. Speaking of Treasury Bills, they are also low-risk investments since you can count on a guaranteed return over a certain period of time and they are supported by the government. If you hold until maturity, you will receive a nice guaranteed rate based on the length of the maturity and you won't be responsible for state income tax on the interest, claims Chavez. Compared to money market funds, this option offers less liquidity due to its maturity time. However, the duration can also be quite brief, ranging from a few days to a year. Treasury bills can be purchased directly from the Treasury Direct website or through a broker such as Fidelity or Charles Schwab. 10. Build an emergency fund. Last but not least, the option to invest $1,000 for maximum returns is to have an emergency fund. This fund is essential to your overall financial stability, as this will prevent you from stretching your budget too thin or incurring debt when faced with unforeseen costs, such as a job loss, unexpected medical bills, or unanticipated house or auto repairs. Generally speaking, experts advise having 3 to 6 months worth of living costs set aside in your emergency fund. In case you're not quite there yet, $1,000 can be pretty helpful. Savings account with a high interest is a smart place to keep your emergency reserves. You can be sure that you will receive compound interest in this manner. The annual percentage yield (APY) on some high-yield savings account is currently close to 5%, which is a return not seen since the 1990s. They are also essentially risk-free because these accounts are often FDIC insured. Thanks for being with us in exploring the ways to invest $1,000 for maximum returns. From buying an S&P 500 index fund to having an emergency fund, we have seen the various useful options. If you have enjoyed this video based on credible investment options, don't forget to share and subscribe. Stay tuned, as we'll be back soon with some more exciting content.